Welcome back to The Street here on BNN Bloomberg. It's time now to welcome our featured guest of the morning. She's Nadia Lovell, Senior U.S. Equity Strategist at UBS Global Wealth Management in New York. Nadia, wonderful to see you. Thank you so much for joining us today. We and investors around the world are watching the events in Washington at 2 p.m. Eastern time today, when the U.S. Federal Reserve Board, of course, will make its latest rate announcement. No rate hike is expected. And if I understand your position and the position of your colleagues at UBS correctly, you believe the Fed is now finished raising rates in this cycle, correct?
Yes, Paul, that is our core view. We think that the Fed ended in July, so we aren't looking for a rate hike today nor in November. Now, of course, all eyes is going to be on the dot plots, and it's a close call on if those will change. Of course, the medium dot for this year does suggest an additional rate hike. I think what will happen is that, progress has been made and that's been acknowledged. But we did hear from a number of Fed speakers recently that did highlight that inflation remains too high and the job market a bit too tight. So it's unlikely that you're going to see any changes in the 2023 dots, because the Fed probably wants to maintain that flexibility and not declare victory too soon, to just have that data dependent flexibility. And also, I don't think the Fed wants financial conditions to loosen too quickly. But what we are looking for, Paul, is for the expectations around inflation for 2023 to be trim. I mean, you're already seeing core PCE trending below what the Fed thought back in June. And so we're looking for, in the summary of economic projections, for that to come down for 23 and for GDP growth to go up, because U.S. economy has been so strong this year. And even the third quarter is trending at about 3%. But I think the focus, again, is going to be on the dot plot for 2024. That 100 basis points cut that the Fed had penciled in back in June for 2024. Does that remain? Does that change? We do know that the market right now is pricing in just 75 basis points cut in 2024. So if that changes to the downside, I don't think it would be a surprise to the market. We do know if rates remain high for too long, that's going to be a headwind to economic growth. But we think overall the message from Chairman Powell is going to be balanced, Paul.
The Bank of Canada has signaled that it now expects inflation in this country to hit the 2% target sometime in the middle of 2025. Has the Fed sketched out an estimate on when U.S. inflation hits 2%?
That's probably going to be more a 2025 or 2026. We'll get an update. We'll get 2026 projections will be introduced today. And that's probably where we're going to see that 2% hit. I mean, our core view, we think that we get there faster than the Fed is penciled in. We already see some progress on core inflation. Of course, yes, the Fed preferred measures is PCE, but, CPI is also sort of an indication of where that could eventually trend. And we're already seeing some progress being made. Yes, headline temporarily has been elevated just due to energy prices. But when you look at core CPI, that is on a downward trend, and that should continue. We're seeing persistent disinflation within goods. We're also seeing some ease and some slowing in inflation on shelter. Rental agreements, new rental agreements suggest that it should continue. And then also we know used car prices had been a big part of a push up in core inflation over the last couple of years. Over the last few months, we continue to see lower prices from the wholesale auction prices and used car prices. And that's just suggests that should continue to feed through the consumer prices into early 2024. So our core view, we think that inflation is going to come down faster than the Fed. We're actually looking for core CPI. When you flip the calendar year into 2024, we think that that's going to have a low 3% handle in the low 3% range in early 2024. And so by the time we get to 2025, we think that you should be able to be back towards 2%.
Okay, you mentioned energy prices. They are a big factor here in Canada as well. They push up headline inflation. They're excluded from core inflation. Gasoline prices were one of the biggest upward influences on headline inflation in the numbers we got yesterday here in Canada. That's all tied into the escalating price of crude oil. And you think that story's not over yet? You think crude oil prices have more to go?
A little bit more to go, but not that much more. I mean, we sort of have been bullish on oil for quite some time, and we actually upgraded the energy sector back in June. And how we're thinking about it, we thought that oil prices, Brent oil, would get to $95 by the time we got to the end of the year. $95, we've gotten there earlier than we expected. We do think that oil is likely to remain in this sweet spot of $90 to $100 in coming months. We don't think that oil will get above $100 on a sustainable basis because we do think at that point that Saudi Arabia would step in to add back barrels to the marketplace to restore that balance. Just given the implications that it would have in terms of demand destruction if oil prices above $100 for too long. I mean, obviously, demand remains strong. It's not just the supply that's pushing up oil prices. Overall demand has remained strong, particularly even in China, where you have seen weakness on the industrial data, but the mobility data has been so strong, and you're seeing record level imports driven by gasoline as well as jet fuel prices. And so we do think that oil prices are sustainable in this current range of $95 into 2024. We think that Saudi Arabia is going to do whatever it takes to make sure that the oil market is well balanced.